All of us are fascinated by the stories of multibagger stocks. Examples of how Bajaj Finance, which got listed on the stock market way back in 1995, has given 27% returns compounded annually till date, or how Page Industries, the company that manufactures and sells the famous jockey brand, has been a huge multibagger and given 33% compounded annually since it got listed. To be honest, stories like these do make our heart race a little, as we're lost in the dream of being rich in the future. But what we do fail to realize is that majority of us exhibit a survivorship bias. People only talk about the few companies that have lasted the test of time, but fail to consider that for very few selected stocks, there are thousands of companies that fail to deliver returns over long term, and many even go out of existence. So, are the examples of multi-bagger returns and stories of rags to riches all a big lie? Not really. Let's take a look at this. When we do talk about multi-bagger stocks, we fail to realize that while an investor might have 2 or 3 of such multi-bagger stocks over a longer time period, majority of the stocks in a portfolio might not perform great over time. So the returns of our portfolio will normalize and we might not be earning as much return as our individual multi-bagger stocks do, but will earn a weighted average of all the stocks in our portfolio. According to multiple surveys conducted, majority of investors are not able to beat the market, let alone retail investors. Even professional money managers find it hard to beat the index returns over a long period of time. Why does that happen, we may ask? Well, let us give you a very basic overview of how constructing an investment portfolio of stocks look like and how many assumptions one has to take to calculate an intrinsic value of the stock. We'll be talking about a fundamental approach and not a quantitative approach for now. What we do is, we take a company and start analyzing its past financial performance briefly. If we consider its fundamentals are good, we do a deep dive into its revenue streams and try to predict how the various sources of revenue will pan out in the future. Why do we do this? Because stock market is a forward-looking machine. All it cares about is what will happen in the future and not about what has already happened in the past. Along with our revenues, we try to complete our forecast of all of our financial statements so that we can calculate the cash that will be freely available to the equity shareholders after everyone have been paid out. This free cash flow is very important from an investor's perspective. This future free cash flow is brought to the present to calculate its intrinsic value. And how is that done, we may ask? By dividing it with the required rate of return. And this required rate of return of equity is also calculated using certain assumptions. All of this work is done for a single company, and we might not even invest in it as it might be overvalued after all of this calculation. This shows how difficult it is for a retail investor to construct a portfolio, and it might not even match the index returns of the stock market. So, what is the solution? Although it is difficult to outperform the market, still certain number of investors are able to do so. And until we reach that level of expertise, we should stick to mutual funds or index funds and let the experts do their job. So, how to decide which mutual fund or index fund should we buy? Well, hang on to the channel because we will cover all of this in our future videos. Thank you so much for watching.